Welcome to the debate. Today, we are immersing ourselves in one of the most dynamic and, frankly, compelling sectors of the Indian consumer market, the rapid expansion of fragrances. Our focus is going to be razor sharp, though, specifically on the price bracket that our source material identifies as a critical sweet spot, premium perfumes ranging from, say, 3,000 to 8,000 rupees.
And the central question that really comes out of this is, is this segment genuinely the accessible, highly profitable opportunity it looks like on paper for new domestic D2C brands?
Exactly. Or are the mandatory upfront investments, the high competition, and all the associated risks likely to just completely undermine that projected 16 to 18-month timeline to operational profitability?
Right.
I'll be arguing that the investment potential here is compelling, driven by some really powerful structural advantages and high margins.
And I'll be taking the opposing view. While I agree the market itself is enormous, the path from those tantalizing gross margins to actual retained net profitability is, well, it's fraught with severe financial and operational risk. I think that aggressive timeline is highly questionable.
Okay, so let's start by establishing the economic reality here. I call this the sweet spot because it's where consumer aspiration really meets digital accessibility, and it generates some truly superior financial returns. The data backs this up. The premium segment is growing, 15 to 18% annually. That significantly outstrips the overall fragrance market's growth of 8 to 12%. It just shows that consumers are actively shifting their spending toward these more aspirational products. But the real story for me is in the unit economics. We are looking at gross margins that run between 55 and 70% in this tier. Now, you compare that to the mass market, where they're often struggling to even hit 40%. The difference is just staggering. When the total cost to manufacture a high-quality 50 milliliter unit is only between 160 and 360 rupees, it means the cost of goods is less than 10% of the retail price. This gives these domestic D2C brands a phenomenal economic advantage. And the D2C model itself boosts net margins to 40 or 50%, which is just far superior to the 25 to 35% you see in traditional wholesale.
Okay, that gross margin is certainly tempting, but I have to push back hard on this idea of immense padding. That high GM figure, it's a bit of a mirage until you factor in the really crucial variable costs that define the D2C world. You're right, the unit cost is low, but the cost to sell that unit is immense. The financial projections in the material, they show net margins just plunging to 25 to 40% once the reality of e-commerce kicks in. And this is because of two key drains. You've got platform commissions, which are 12 to 18%, and this is the big one, the skyrocketing customer acquisition cost, or CAC.
Sure, the CAC is a factor.
It's a huge factor. For a new brand, acquiring a paying customer is projected to cost anywhere from 200 to 500 rupees. You add to this the need for massive brand investment. 15 to 25% of year one revenue is just for marketing. And what do you get? The source material itself projects a net loss of 19.5 lakh in the first year, and then another loss in year two. It's a 3-year journey just to break even. This is not the accessible, immediate win your margin figures suggest.
Okay, I see the net loss figure. I do. But I believe we need to frame the financial reality a little differently. Focusing just on the net loss confuses operational viability with financing cost. Let's look beyond the bottom line for a second. The projected EBITDA, earnings before interest, taxes, depreciation, and amortization, is actually projected to be positive in year one, about 6 lakh. This positive operational result confirms the core unit economics are sound. The business is generating more cash from sales than it costs to produce and market the product. That's the definition of operational health.
But is it?
The 19.5 lakh net loss you're highlighting is almost all due to a non-operational expense, the debt servicing interest, which is projected at 30 lakh. It's crucial we separate these. Selling premium fragrance is inherently profitable on a per-bottle basis. The loss is caused by financing the brand's growth, not by the business itself being unprofitable.
Plus, the asset-light D2C model gives you a huge structural advantage by eliminating the 30 to 40% import duties on finished international goods. That is an interesting reframing, but it kind of glosses over the fundamental challenge, doesn't it? Operational viability, which EBITDA measures, is completely meaningless if the business runs out of cash in the first year. I'm sorry, but I just don't buy that clean distinction you're drawing. They are inextricably linked because you need the debt to bridge the operational gap in the first place. That 50 to 100 lakh loan isn't just for servicing interest, it's required to cover working capital, buying inventory, managing receivables, and yes, covering those initial deficits. The material's own cash break-even analysis drives this home. It estimates the business needs 414 lakh in annual revenue just to cover its costs. Compare that to the projected year one revenue of only 280 lakh. That gap, it's a massive liquidity risk.
Okay, on the topic of upfront costs, compliance. The barriers are temporary. I mean, yes, the list of bodies, FSSI, BIS, CDS code, PSO, it sounds intimidating, but it's a one-time expense and about 8 to 12 weeks of time. Once that's cleared, you have a stable foundation. The real debate, I think, is competition. And I'd argue the competitive environment is manageable because the opportunity is in the gaps left by the traditional players. The source material calls the intensity moderate. International luxury brands like Creed and Tom Ford they're only now tentatively exploring Indian e-commerce. They aren't built for D2C speed or efficiency, and established domestic players like Bombay Perfumery are often supply constrained. This creates a vacuum. A new brand can win with genuine differentiation. We know consumers will pay a 20 to 30% premium for sustainability narratives, and more importantly, D2C enables highly efficient influencer marketing, which has a 40 to 60% lower cost per acquisition. That directly addresses the high CAC you pointed out.
That's a compelling argument, sure, but have you considered the aggressive nature of the competition that is already specialized in this price point and, frankly, excels at the digital game? You're focusing on the old guard, but the new threat is from value-focused players. Middle Eastern brands, often specializing in things like oud, are growing at a blistering pace of 25 to 35% a year. And why? They're aggressively undercutting international prices by 30 to 40% while offering the kind of quality and projection that really appeals to the Indian palate. Brands like Oud Arabia and Latafa. These are not slow-moving luxury houses. They are e-commerce native. And then, you have to address the corporate players. The entry of brands like Titan's SKAN, which is in that lower premium range, signals that established Indian giants are now looking up market. They have superior capital, distribution, and supply chain leverage.
The competitive pressure is intensifying rapidly from the bottom up.
I would frame that corporate entry differently. I mean, Skin's focus on the sub 4,000 rupee market actually reinforces the strength of our target bracket. It validates the trend toward premiumization without creating a direct price war. But let's talk strategy, because this is how a new brand overcomes that competition, by targeting the right consumers. The growth plan focuses precisely on the aspirants, age 25 to 35, wedding-linked consumers, and so on. Together, they generate 35 to 45% of the segment's value. And crucially, the expansion emphasizes Tier 2 cities, Jaipur, Indore, Pune, where consumption is surging 25 to 35% annually. E-commerce is the great equalizer here. And let's not forget the male fragrance segment, which is exploding at 20 to 30% annual growth. It's a massive, relatively untapped demographic.
I see why you'd emphasize Tier 2 growth, but scaling geographically in India, I mean, it's just not as simple as flipping an e-commerce switch. That scalability comes with huge operational complexity. We're not dealing with one single market. The regional variations and preferences are incredibly acute. The material confirms that North India drives 35 to 40% of demand and spends 2.5 to 3 times more per person on fragrances. That's not just a number. It means you need highly localized marketing. You need heavy, long-lasting scents like oud in the north versus lighter, fresh scents somewhere else. For a new brand launching just 4 signature scents, trying to cater to all of that, the execution risk is just exponential. And this is all compounded by the heavy reliance on seasonal spikes.
Diwali and the wedding season account for a massive 50 to 60% of annual sales. If the brand fails to execute its marketing perfectly in that crucial window, they face a catastrophic inventory imbalance, which just eats up the working capital we already established is perilously low.
But that inventory challenge is precisely why the high gross margin is so critical. A 70% gross margin gives a brand the financial cushion to manage that risk. It allows for flexibility in strategic discounting or targeted liquidation, minimizing the hit. That's a flexibility a mass market brand just doesn't have. The financial structure supports the risk because the reward is so high.
That assumes flawless management of everything at once, maintaining a 40% repeat purchase rate, keeping your CAC under 500 rupees, navigating all the regulations, and pulling off perfect seasonal stocking, all while walking that liquidity tightrope. It's a very optimistic outlook.
So to summarize my position, the data just overwhelmingly supports the structural potential here. The consumer trends are aligned, the e-commerce reach is there, the unit economics are undeniably robust, yielding exceptional gross margins, and the path of long-term profitability is validated by that positive EBITDA in year one. The initial net losses are simply a necessary cost of financing rapid growth, not a fundamental failure of the business model. With focused execution, a brand can achieve that projected 18.6% net margin by year 5 and deliver really exceptional returns.
And my position is that while the market opportunity and the gross margins are intoxicating, they mask significant short-term financial peril. This sweet spot is not an easy entry point. Profitability is not immediate. Investors have to tolerate 2 years of net losses while fighting off aggressive competitors. The viability rests entirely on a brand's ability to turn that projected margin into retained profit by managing 2 huge variables: getting customer acquisition costs down and successfully bridging that critical working capital gap to hit the cash break-even target.
Ultimately, I think our discussion illuminates that the viability of this market rests less on the size of the opportunity, which we agree is vast, and more on the precise financial and operational discipline required to navigate those high variable costs in the critical first 18 to 24 months.
Indeed. The difference between realizing that enormous potential and facing financial distress is purely a matter of execution efficiency. It is a high-stakes, high-reward environment where only the most disciplined D2C brands will survive that initial liquidity tightrope walk.